in BW, 3,000 in stock D. Total investment 5,000. Out of this, 2,000 for BW, 3,000 for stock D. Then expected return, calculated expected return, standard deviations are given. 9% and 13.15 for BW. For stock D, 8% and 10.65. Correlation coefficient between these two stock is 0.75. Now, if we calculate the expected return and the standard deviations, so how we can calculate it? We need to go with the equations and we need to calculate. So if you go for calculation on this part, you can see, we can see, right? Expected return of the portfolio, as I earlier calculated, we can calculate the portfolio's expected return. Here actually, you can see stock D and BW, 2,000 BW, this is 3. So 2,000 out of 5,000 is the weight, right? First one, 2,000 out of divided by 5,000 is the weight. So 2 upon 5, so it should be 40%, okay? First one is 40%. So it means the other one is 60%, right? If you are calculating this part actually. Yeah. Right. So if we take the weight of the BW stock, BW, right? You can see 2 out of 5, this is 40%, okay? So the other asset must be then 60%. Right, then we can go for here, expected return calculation. So 0.4 multiplied by what is the return rate? So BW's return rate is 9%. So if you take the expected return 9 here, 0.09 plus the other stock is stock D. So that is 0.6 weight. Then expected return is 8%. So if you go for 8% expected return, you can calculate how much is the actually expected return of this portfolio. If you use the calculator and you can calculate the expected return. So if you calculate the expected return for this actually, it should be 0.4 into 0.09, 0.036 plus 0.6 into 0.08, 0.048. 0.048. So if you're adding both, 8.4%. 8.4% is the portfolio's expected return. Okay? Right. So now we can calculate the portfolio's standard deviation by using this equation. Right? We can copy paste this equation and we can see what is the portfolio's. This is actually portfolio's variance. Right? So if you take this portfolio's standard deviation, right. Okay, so you need to take this portfolio standard deviation. So portfolio standard deviation is actually this is the portfolio standard deviation we need to calculate now. Okay, so it must be here. Right, this is the standard deviation equation. Now, if you replace the values based on this for our calculation part, right? How we can calculate the portfolio standard deviation of portfolio. So, weight of asset A is 0.4, stock A we take 0.0, this is BW 0.4, power 2, okay? Power 2, but we can use the power 2. Or what other way around we can put like this. 0.4 multiplied by the standard deviation. Standard deviation given for you here for stock BW 9%, 13.15. So you can consider this 0.1315 within bracket. You can put the power 2. Either of the way you can calculate. So power 2 plus the other asset is 0.6 weightage multiplied by the standard deviation of the other asset 8% into 10.65. So here it is then 10.65. So if you go for 10.65, then power 2. That is the second part of the equation under the portfolios equation. So then we can go for power 2. Then we need to use the rest of the equation. We can see that is given for you 2 multiplied by weight. 2 multiplied by weights. So first weight 0.4, second weight 0.6. Then correlation coefficient given in this example 0.75. Then standard deviation of A given as 0.1315. Then standard deviation of B given as 0.1605. So this is the, the other part, right? So if we calculated all three, this entire equation, if you solve it, you can find what is the answer for this portfolio standard deviation, right? So now we can calculate it here based on this. So if we take one by one, we can calculate. There are three parts you can see. First part related with this part, right? 0.4 multiplied by 0.1315 power 2. Right? That is the first part. If you calculate that part, that become 0.002766. Right? Then the second part is this 0.6 multiplied by 0.1605 power 2. That become 0.004083. Then we can go for the rest of the equation here, this third equation, third part of the components. That is 2 multiplied by 0.4 multiplied by 0.6 multiplied by 0.75 multiplied by this 2 in the standard deviation. 0.1315 multiplied by 0.1065. So that becomes 0.005042. Now we can add all three, and that is the variation, right? So if you are taking all three, adding all threes, so plus 0.004083 plus 0.002766. So it becomes equal to 0.01189, right? So if we take the square root of this becomes 10.9% standard deviation, right? This is variance, this is standard deviation. So directly we apply the equation. and we can calculate it now based on the given example. So what is the standard deviation of the portfolio? So in case of portfolios, right, if the proportions and weight given for two assets, you use this formula, use this equation, and directly you put the answers, right? What is the weight? What is the standard deviation of the assets? Then apply all, and only other rest of the things are calculated, right? You can see. So that is what this is actually. We need to take standard deviation with the square root, okay? Square root of this. We need to put this sign here, square root of this. That is actually 10.9 percentage is the portfolio's expected return plus the portfolio's risk. So we simply learn for two asset case how to calculate the portfolio's expected return. Right? So there is no hard to understand since I didn't go with the complicated part to discuss this. Only I show you directly how you can use this equation and derive the portfolio's risk. If you know that, that is enough. Only you need to know correlation values are finally decide what is the level of portfolio's risk in the assets. So only two asset cases you learn. Right, now we are moving to the last part of this risk return topic. So this is connecting with the one of the theoretical model. So risk and return is the two concepts. But when we take asset pricing models, in finance, we use the word asset pricing models. This asset pricing models, the first model is in the theoretical model is called this, first theoretical model is called CAPM, right? Asset pricing model. If you go through the finance literatures over the time, lot of models emerged, right? This is the first model emerged as asset pricing model in 1960s. Actually, William Sharpe explained this model initially, how we can take this expected return and the risk, systematic risk relationships. So different asset pricing models are evolved over the time. While this asset pricing model is a first model, theoretical model, I will explain. Since this is still application, practical implications are there. Still in the prediction on this share prices or equity stock returns using this two-factor model. This two-factor model explaining what is the relationship with the risk and the return. So I will also see what is the theoretical model and the explanation on these relationships. So in order to understand this relationship asset pricing model, this model is based on the assumptions. So what are the assumptions of this model is basically carries? So we assume under this model, capital market is efficient, right? I think I may discuss briefly on the financial market or stock market, that is called capital market in the introduction class, that capital market is efficient. So theoretically we assume this is efficient market. So capital market is efficient means all the informations are accessed by everyone. So that is called capital market is efficient. So coming to other point with the assumptions we assume, in the financial market, there is no such transaction cost. Transaction cost means once you are issuing the bonds or issuing the equities in the market, there must be a issuing cost. But that in 1960s, that is very less amount. So the model derivation assumption, there is no transaction cost. Then basically we assume all the investors have a rational decision. They don't have a bias towards any decisions. They are rational, right? Economic theories are explaining consumers are rational. Here we assume market investors are rational. They don't have bias towards anything. They don't have a different biases. So accordingly, considering the risk in the market, they consider the risk in the financial market basically. The two types of risk is discussed. Okay, so you can see the risk. Risk can be divided into two, systematic and unsystematic risk. What is the meaning of this unsystematic or diversifiable risk? That risk is specific to particular company or industry. That is not common risk for everyone. Say example, particular company's CEO is inefficient. That is the problem only to that company. That is called this diversifiable or unsystematic risk. That is unsystematic among the companies. Okay, that is one. Other risk is called systematic. That is called you cannot diversify. You cannot eliminate. Uncontrollable risk. Say market factors influence on the stock returns, economic factors influence on the stock returns. That is common to everyone, every company. You cannot control. Inflation rates you cannot control, government policies you cannot control, market inefficiencies you cannot control. So all the players, all the listed companies in the stock exchanges go through this risk. That is called actually, what do you call, systematic risk. So systematic risk is that. Right, in case of these two risks exist. As I discussed, these market factors or economic factors or control beyond this firm, political changes, everything. That is categorized as systematic risk in the system. Right? So, company should face this risk to maximize the return. So, when Sharpe explaining the model, Sharpe consider this systematic risk. You can say, I can show this actually with the graphs. So there are two risks. One is systematic risk and other one is unsystematic risk. Total risk connecting with this. So changes in this you can see economy, taxes, government, market, global changes. All are systematic risk. You cannot change by diversify your portfolios or company cannot eliminate anything. Risk is always exists, it goes parallel. But if you take the unsystematic risk, that is you can specific to the company. As I explained, that is specific to the company. Due to that, you can diversify and you can eliminate or minimize that risk. That is what you can say. Over the diversification, this risk is declines. You can minimize this risk. That is up to the company. Company can minimize that risk. So now we move to the measurement on this part. So this CAPM model only considering this part of this systematic risk, since that risk only cannot be unavoidable risk. So what is this systematic risk? So systematic risk is actually measured through the beta values. You all might heard about the stock beta in the Colombo Stock Exchange announced these betas. Beta values are there. What is this beta? A beta is the index of systematic risk. That is calculated index. So how that index is calculated actually? That is measurement on the sensitivity of individual stock returns to how the changes with the market portfolio returns. So sensitivity, so overall market return changes, say stock market return changes, how to change with the your company return. What is the sensitivity? The how we measure that changes actually, this is normally we sensitivity changes, we use the word delta, right? So that delta changes how we can measure actually with the overall market performance, how much return is changed, market return, how our company return change. That is called, that proportion, that slope is called actually beta. So beta is actually stock returns. If you have a portfolios of stock, more than one stocks, then you have a portfolio beta, and all are exist for the companies. So in case of this beta coefficients, that shows how much particular company is stocks per buying or selling is risky. So you can see here, this is measurement for portfolios, risk, measured risk is given. You can see. This is stock 1, beta is 1.65. Stock 2, beta 1. Stock 5, 1.25. So proportions are weights are given. So you can see what is the portfolio B's average portfolio beta, right? So multiplied by the weight in the portfolio each asset beta, then finally we derive 1.2 nearly is the portfolio B's risk. This risk is less 0.91. Higher beta shows high risk, lower beta shows lower risk. Okay, right. So here I show how these betas are measured actually. You can see here. So beta measurement is the sensitivity of the changes. So that sensitivity of the changes, how we can say this is a plot the lines or regression graph. If you take, you can see. This is called excess return on market portfolio. This is x-axis. Y-axis, excess return on particular company stock. Say if we take the example, if we take commercial bank. So here this is the Colombo Stock Exchange, all share price index changes. Maybe recently you read it from the papers or maybe newses. So all share price indexes are back to the normal and increases, recorded good all share price in the CSE, right? You heard about the newses. So that is overall how market perform. So overall market performance means actually the nearly 290 companies are listed in Sri Lankan market. So how this weighted average of all 290 companies returns, excess returns, that is called market portfolio. So that is the market performance. So compared to the market movement, how as a commercial bank, particular bank's return, stock return changes. So you can take these changes by, drawing this changes by slope of the curves. You can see how you can measure the slope. You need delta change of delta x divided by delta y. Delta x you can see considering this delta y towards delta x. Delta y is change in excess return of the company. Delta x is change in market portfolio return. That is called slope. That is what I put. Drawing this line named as a characteristic line, right? These lines are known as known terms for terminology, characteristic line. So all lines have a different slopes. Slope is this part, right? Slope is this part. So why these curves have a different slope? Beta is different. So if the beta is 1, so stock return, this market changes to individual company changes equal. Say example, so particular company 10% excess return, while the market also performed 10%. So this is actually, we can say beta equal to 1. So beta greater than 1, then what we can see? The excess return of the company, delta y change is greater, right, compared to delta x change. So delta y, slope is the delta y over delta x. How we can calculate the slope? Slope is always, right, delta change as change in right? Delta, we couldn't find the symbol on delta, right? So you can say change in stock return to market return, or change in stock return divided by change in market return. Okay, it means how we are measuring. You might be heard in economics classes, slope is delta, right? That like a triangle, delta y divided by delta x, right? So considering this delta y and delta x changes, so in case of beta, so your return, commercial bank is 12%, this market performs 10, then 12% divided by 10, delta y over delta x, 1.2. So beta is 1 and aggressive. So defensive stocks, that is your commercial bank only performs 7%, but market showing a 10% excess return. So it is 0.7. So now you can understand. So different slopes, sensitivity changes for this overall market change. How particular company stock returns moves. That is what we can say as a beta or maybe systematic risk exposed by the company. What is the meaning of that? If even the exchange rate changes, inflation changes, or interest rate changes, or tax policy changes, how to impact individually for the company? Not every company is affected, but the degree of affection can be different. So that is what beta is measured. So measuring that beta actually based on that model is proposed by Shah. Capital asset pricing model is derived based on this. How expected returns for the stocks can be measured. Expected or required return on the stocks, on the companies. So that is equal to always risk-free rate plus risk premium. How you can get the risk premium? That is always, you can see market premium multiplied by the beta. Market risk premium multiplied by the beta. So RM bar talking about the actually average market return minus risk-free return. That is called market risk premium, this part. Market risk premium multiplied by this beta is the risk premium. So risk premium plus this risk-free rate is the expected or required rate of return on stock. There are two things you can say: risk-free rate, risk premium. What is risk-free rate? As I explained, there is no risk. So there is a clear certainty of receiving the returns. That is called risk-free rates. So we assumed always commonly measured the risk-free rate of return by the 3 months treasury bill rates. Every country, everywhere that is accepted conceptually, 3 months treasury bill rates can be used as risk-free rates. So this risk-free rate is treasury bill rate. Beta you need to calculate, as I say, slope of the curve as I show the characteristic line. This is average market return over the time period you can calculate. Then you can find what is the risk premium and overall what is the required rate of return on asset by using CAPM model. So CAPM model explain the relationship between the risk, systematic risk measured by beta with the expected returns or required rate of returns of the stocks. This is well established model, still in the application practice. So that is what I explain this part. You can see risk-free rate and market risk premium. What is this risk premium? So now we can see what is the relationship between this beta and the required rate of return. That is called security market line. Theoretically, we use the word security market line. Explain the relationship between the beta or the systematic risk and the expected returns. It means higher the beta, higher the expected return. Lower the beta, lower the expected return. That is what this graph is showing here. You can see risk-free rate is 7. So that time there is no risk. That is what it shows as a 0% as a beta. Beta is 0. Then the return rate is increases. Beta is going from different betas 0.5, 1. You can see that is what it explains. Difference between these two security market line and the risk-free rate is the risk premium. Right? Market risk premium is with the average market return to risk-free rate, that is market risk premium. But risk premium is overall premium, right? That is the difference between the risk-free rate, but you are calculating your required rate of return. That is your risk premium. Okay? So it's very clear, but we have discussed a theoretical model to apply and measure the required rate of returns in the stock markets. Now we will take this theoretical model, what I have discussed up to now, to take the practical application on the model. So here you can see I take a simple example with that. Particular corporation computer software developer wishes to determine the required return on the asset set. It has a beta of 1.5, risk-free rate of 7%, average market portfolio's return is 11. So what is the required rate of return on asset set? So I used the equation shown in the previous slide. Risk-free rate 7 plus beta 1.5 multiplied by average market return 11 minus risk-free rate 7. So here 11 minus 7.4% is the market risk premium. So multiplied by the beta, then you can see 13% required rate of return. So difference between this risk-free rate and the required rate of return is the risk premium. So 6% is the risk premium. Okay, so we apply the model. We can use this other than dividend discount models, right? We learned in the last class how the dividend constant growth model or variable growth models, we calculate that required rate of returns. Using that, we predict the required rate of return. Here, CAPM model also you can use to predict the required rate of return, right? To stock returns, equity valuations. So now I come to the final part on the risk return discussion. You can see. So here, Lisa B Limited, Millers B Limited is determining the rate of return required by the stock investors. Lisa is using 6% risk-free rate and the long-term market expected return 10%. Stock analyst following the firm has calculated that the firm beta is 1.2. What is the required rate of return on the stock of B Limited? Right? Can you try? What is the CAPM model based on the CAPM model? So what is the required rate of return on this particular company? Calculate that amount. What is the answer? Find the answer for first part using the CAPM model. We need to calculate the required rate of return, right, of these Lisa companies. So we need to take the risk-free rate 10.8, okay, 6% that is given you as a 6%. 6% plus beta is 1.5. Then market return is 10%. Minus risk-free rate is 6%. Then if you calculated this, your answer become 4, 6, 5 point. Correct, no? Beta is 1.2 here. This is the difference. So it become 10.8. Okay? Right. That is you directly use and find it. Now, the second part of this continuation of this example, you can see this, what is this intrinsic values of the stocks. So intrinsic value, what is the terminology stand for? Internally worth of the value. Or we can, on the other hand, we can use the word theoretical prediction of the theoretical price, right? Theoretical price, or we can say as a internally worth. How much actually worth? Internally worth means actual worth of the stock. That price, stock price is called actually intrinsic value. Okay, so here what we are doing now. So we align with she's using the constant growth model of Lisa, estimate the dividend next period. Dividend is given for you next period, 0.5, and V limited will grow at a constant rate of 5.8. Calculate the theoretical intrinsic value. The stock currently selling 15. What is the intrinsic value of the stock? So if you use this, what we learned in the last class, so constant growth model. So how we can calculate the today's price based on the constant growth model, right? So we calculate the today's price based on that current price. D1 divided by R minus D. This is the equation last class we learned. So here D1 is given for you. D1 is 0.5. Okay, 0.5 divided by R minus R we calculated 10.8. Okay, minus growth rate is given, that is less than 10.5, that is 5.8. So that is 5.8. That is 5.8. So now we can calculate what is the price, right? So if you use this constant growth model and we found the theoretical price, actual worth of this price by using the dividend model, we found the price 0.5 divided by this 10.8 minus 5.8. So that is equal to 10. 10 rupees is coming. Okay. So once we predicted by using our theoretical basis with the models, we use the CAPM model for record rate of return and the constant growth model for predicting the share price. Price is now, the worth is only 10 rupees. What is the market is telling? In the market, the price is 15 is given for you. Market price can be different, right? So that market price can be different. So price is 50. So this is called this overpriced, underpriced, or overvaluation, undervaluation is happening. So here what is happening here in the market overpriced. 10 rupees worth shares only priced 50 in 10 rupees. So market overpriced. This is called overvaluation of stocks. Okay. So if we assume the market price is 7 rupees is the market price, then we can say that worth 10 but market is showing underpriced. underpriced or undervalue the stock. So market prices are different from our theoretical or intrinsic values since due to other factors or market efficiencies or maybe external factors influence on the stock market returns of the stock prices. That is cannot be controlled by us. Developing country market is different from the Sri Lankan market. So market inefficiencies and some other reasons, or maybe stock, maybe domination or insider readings, policy changes, or maybe these reasons that market fundamentals and market inefficiencies, the prices are over and undervalued. That is what you can say. The volatilities are there in the graphs, right? Stock market graphs are volatile, highly stock prices are volatile. That you cannot predict, that prediction is different, high volatiles are coming, that is due to market risk or market, inefficiencies. Then you can earn the additional excess returns from those markets. Okay, so now it's basically I understand and I explain that you all understand the CAPM model, dividend discount models, valuations, and market intrinsic value to market price, how these prices are different, then when investor can buy, when investor can sell, when what would be the recommendation for investors, equity analysts. This sort of work is the equity analyst job. They are doing this job. Okay, when they can buy, when they can sell, all these things. So this is what risk return part connecting with the valuation as well. So I think I prepared the well practical assignment on this. I will explain on the tomorrow's class. You can start your assignments based on all I completed the discussion, what you need to do for assignment. So this is the main part on the assignment as well. Once you are doing practical data with the practical ground, with the application on what we do in the financial models, you can understand the differences and you can practically see why the prices are different. What is your recommendation, stock buying and selling recommendation, what is basically you plan to keep. So that is what assignment I will explain on the tomorrow's class, right? So I think I didn't do only one exercise only I covered today. So maybe there are some more exercises are there in the risk return part, right? Do yourself all the exercises and see. I will upload the answers for exercises. So any clarification, any doubt you can ask me even after doing the exercise in the next week class. Any exercise have to do in the class, I can do that as well. Okay. So tomorrow, not next week, tomorrow again I have a financial management finance class, 8:30. So tomorrow 8:30, I will explain assignment and the other topic I uploaded cost of capital. So any clarifications, any exercises I need to carry out today's class also. If we want, we can do. Or if you can manage your end, I don't want to do it. So that is up to your request. Okay. Right. So is it clear on what we have discussed? Any doubt on what we have discussed? Students? Madhushan, Kelum, Jayani. What about? Okay, clear. So